Hello everyone, today is Wednesday, February 19. Let's take a closer look at the charts for the euro and the British pound and assess potential market movements. As seen, the euro remained under pressure until midday yesterday, after which buyers took control. Despite the earlier downward correction, market sentiment remains bullish. Meanwhile, the British pound has been in strong demand. Sellers made several attempts to push the pair below the 1.2580 level, but failed. As a result, the pound-dollar pair hit a new one-week high, indicating continued bullish momentum. As for yesterday's statistics, data on economic sentiment and current conditions in Germany exceeded expectations, which allowed the euro to hold steady. However, during the US trading session, the European currency came back under pressure, weighed down by Donald Trump's announcement to escalate his trade war by imposing 25% tariffs on car, semiconductor, and pharmaceutical imports starting April 2. This move is expected to provoke the retaliatory actions from other countries, weakening demand for the euro, the British pound, and other risky assets. As a reminder, Trump had previously announced 25% tariffs on steel and aluminium imports, which are set to take effect as early as March this year. Yesterday, market participants also focused on the meeting between senior US and Russian officials. According to Russian Foreign Minister Sergei Lavrov, his discussion with US Secretary of State Marco Rubio was useful and productive. They agreed to reset diplomatic relations, expedite the appointment of new ambassadors, and establish a process for settling the Ukraine conflict. While such developments could have boosted demand for risky assets, no substantial details were provided, leaving traders cautious and preventing any meaningful market reaction. Today's macroeconomic calendar features UK consumer price data. The annual inflation rate is forecast to have risen to 2.8% in January, defying the Bank of England's expectations, which had anticipated a further easing of monetary policy to stimulate the economy. Core CPI, which excludes energy, food, alcohol, and tobacco, is projected to come in at 3.7% year-on-year in January, up from 3.2% in December. If these readings exceed consensus estimates, the Bank of England may be forced to pause its interest rate cuts, potentially fueling further gains for the British pound. Traders will also keep an eye on Eurozone current account data and the European Commissioner's winter forecast. Though these reports are likely to have a major impact on market sentiment, the primary focus will shift to the minutes from the Fed's latest policy meeting and comments from its officials. Notably, many policymakers are advocating for a more gradual approach to rate cuts, countering that inflationary pressures could resurface and suggesting that there is no need to rush into further cuts. If the minutes reinforce this stance, the US dollar could regain market dominance, while the euro and the British pound may resume their losses as part of a much-needed correction. With little to support for the gains in risky assets, especially amid economic challenges in the Eurozone and the UK, you should be cautious with long positions. Now let's turn to technical analysis. The 1-hour EUR USD chart shows that the false breakout at 1.0437 will generate a buy signal, pushing the euro up to 0.475. If the price breaks through and consolidates above this level, the path to 1.0512 and 0.554 would open. At the level of 0.554, I recommend going short on the rebound, expecting a move of 35-40 pips. Short positions at 1.0475 and 0.512 should only be considered on the false breakout. In a bear case scenario, if the price breaks below 0.437, the euro could fall to 0.409 and possibly 0.376. At this mark, it would be wise to open long positions on a rebound, aiming for an intraday correction of 25-30 pips. Going long at 1.0409 and 0.437 would be relevant after a false breakout. Regarding the British pound, it continues to trade upwards. If a decline occurs triggered by news of bigger inflationary pressures, a false breakout at 1.2592 would present an opportunity to go long. If sterling sustains gains and breaks above 26.31, the volume of long positions would likely increase, with the pound-dollar pair climbing to 26.64 and potentially reaching 26.92. At this level, traders should consider going short on the rebound, aiming at 25.30p move. Long positions at 26.64 and 26.31 are recommended only after a false breakout. In the case of subdued buying activity, if the price breaks below 25.92, the British pound could drop to 25.50 and potentially 25.15. At this mark, it would be wise to go long on a rebound, targeting an intraday correction of 30-35 pips. Long positions at 25.50 and 25.92 should only be considered following a false breakout in anticipation of a continued bullish trend. Good luck and have a nice day.